All right, so strap yourself in. We're going to go for a little ride here. Go Tech or Go Extinct. I'll just kick this off with a little bit about me. Yes, that's me since Columbia 1990. I started a family over here in the UK. Those are my wife and three kids. And of course, we've got our dog Luna. And business wise, since 1990, I came over to London in 1991, 92. After joining the G Capital Leverage Buyout Group, I joined a Bain& Company spinout called Arkwright. And then after a couple of years there, my boss and I set up our own firm called Ark Associates in 1993. We focused on TMT M&A, capital raising. We grew that to 45 people. And after 10 years, we restructured that. I set up Allegro Capital to advise across all industries, brought in a few partners. We grew that to 35 people. And then 2010, it's time to go back to pure tech and TMT. Now, over these years, I've done some deals. Here you can see a selection of them. I won't go into too much detail, but just gives you a flavor of the kind of work that I've done. I've written this book, which we're going to talk a bit about today. And we've also published some research recently focused on the death of value investing. And this research was picked up and profiled in Barron's and MarketWatch, PE Wire, and about 20 other publications. And we'll get into this today. I think to start, let's just look at what's going on out there. We have this pandemic, and certainly we would expect to see big losses in the market, but we haven't seen that, at least not in the U.S. In the U.S., the Dow's up about 5% this year, S&P's about 13-14%. The NASDAQ is up 40%. While most of the European indices are down. Eurostoxx down about 8%. We see FTSE is down about 14%. The DAX is flat. So what's going on here? Well, I'm going to get into that. But first, let's just step back a minute and look at what this is all about and how it starts. And I think I can say it starts with mindset and also perspective. And Klaus Schwab, in his book, The Fourth Industrial Revolution, which was part of the inspiration for me to write my book, said that most decision makers are too absorbed by immediate concerns, by the things they see right in front of them, instead of being able to think strategically about the forces of disruption and innovation shaping our future. And that's really the starting point. And I go back to 1900, when we saw on Fifth Avenue here in New York City, a lot of horse and buggies. See if you can spot the automobile. It's right here. There's only one. And then only 13 years later, see if you can spot the horse right there. It only took 13 years for a complete transformation of transportation. And that's what we mean when we talk about the forces of disruption and innovation shaping our future. We've seen the same thing in retail. Even going back about 10 years or so, we had the largest retailer in the US, Sears, rocket up by 700% during 4 years from 2004 to 2008. And then it went on a very long decline, similar to how Kodak did, because it didn't adapt to these forces of disruption and innovation and stayed into this linear, non-disruptive thinking, which led to its demise. We've seen this in travel companies. Thomas Cook, 21,000 employees, 13 billion in revenue, had been around for 180 years, filed for bankruptcy in September last year. They weren't living in the 21st century. They didn't notice that the world had changed all around them, and they just effectively let it happen. Many extinct companies, they're extinct today anyway, thought that they were too big to fail. And so it isn't just the extinction, it's going down. What can happen? What's on the way? What are the signs before going extinct? And on this, I mentioned Kraft Heinz, a blue chip. Only a few years ago, 112 billion market cap, heavily leveraged, which caused the company to lay off employees, cut R&D, cut advertising, not focus as much on innovation and marketing. And there have been problems with their adapting to the world, for example, of plant-based meat, with their 40-year-old Boca Burger, which just hasn't been competitive. Kraft Heinz has really suffered, and it's a semblance of its former self. We see in Europe, Henkel, the consumer products, beauty care, consumer adhesives, laundry detergent company, also suffering. And what I find interesting here is there was a press release, the end of November 2016, so at the start of this chart, in which the company proclaimed that accelerating digitization will help us grow our business, strengthen the relationship with our customers and consumers, optimize our processes and transform the entire company. Well, that was, 4 years ago, and we have not seen the transformation. We've seen optimization, but I want to point out here that most companies optimize. Every company should optimize. That's part of what a business is for, is to optimize processes and optimize procedures and methodologies. Most companies have to innovate. But when it comes to transformation, which is really the subject of today, it's extremely challenging. It's very difficult. Henkel hasn't done that. But what about the big one, GE? GE really should have been the world's first trillion-dollar company. This was Jack Welch on a ride here. And it was interesting, coincidentally, that the time he left was the beginning of the end of GE. And it's a sad story. I don't want to spend time on it here today. I'll just say that of all the things that GE didn't do, it was the investment in and acquisition of digital companies, of technology companies that tended to rely on in-house R&D, because Jeff Immelt, CEO at the time, certainly during a long period of this time period, said that if we didn't develop our own technology in-house, then the founder of GE, Thomas Edison, would rise from the grave and shoot me. And this has really caused a major problem for GE. Now, let's look at an interesting case study, Tyson Foods, which by all appearances seems to be doing all the right things and transforming itself into a tech company. We see here that it's transformed its value chain. It's thought very carefully, not just about the source product. In Tyson's case, it's meat. They've also invested in alternative protein companies, but they've used robotics, automation, machine vision, VR technology across the entire value chain. And the CTO, Scott Spradley, is really quite a visionary. He says, in some ways, while we're in the food business, we're a technology company. He says we're on our way to transforming Tyson Foods from an 85-year-old food company to a company that operates at the speed of business with immense digital capabilities. That was a couple of years ago. And if we look at the share price performance, we see that over the last 10 years or so, Tyson has done well and has made investments in different types of technologies, as I mentioned earlier. However, it's lost its way a bit in the last 4 or 5 years. And I would look at this and say, well, this is not what we'd really want to see in terms of transformation. There are things that Tyson could be doing that it's not doing. And what's especially interesting when we do a zoom in on these 5 years is that it's actually now underperformed the S&P 500. If we take this period starting in January 2016, the S&P is up 82%, but Tyson's only up 26%. And yes, of course, there is always a reason why something hasn't worked out. And in this case, the pandemic, problems with factory workers contracting COVID-19 and the like. However, I like to look at things like this, where Tyson made a very smart move in October 2016, investing in Beyond Meat at only a $250 million valuation. And then it increased its stake at a $500 million valuation. But then it decided to divest its stake just before the IPO, partly because they were launching their own alternative protein products. Now, we know what's happened to Beyond Meat in the meantime. It has skyrocketed. It's developed its own brand name. It's going direct to consumer as well as to QSRs and grocery markets. And it's worth nearly $10 billion. And I'm tempted to make predictions. One has to be careful with that kind of thing. But I would say over the next 3, 4, 5 years, Beyond Meat will be worth a lot more than Tyson Foods. So it just begs the question, Tyson seems to be doing all the right things, but something is missing. Now, let's look at the ultimate tech survivor, or maybe not, IBM. Quick case study here. I find this fascinating as a case of reinvention, but it just can't keep up with where the world's going, which is how I'll end this case study. But IBM started out as a mainframe company, then mid-range, then PCs. Well, it couldn't just be a hardware company only and survive. So it was very acquisitive during these early years in the 2000s in services and built up its services division, including acquiring PwC Consulting for $3.5 billion in 2002, which at the time was a lot of money. And then it realized services wasn't enough. It had to really grow its software business. It acquired Cognos for $5 billion in 2007 and did very well with other software company acquisitions to grow its share price quite dramatically. If you look at the scale here, then the world was moving into cloud. And so in 2018, IBM decided we've got to make a big acquisition, a big play in cloud. It acquired Red Hat for $34 billion, which interestingly, many commentators didn't put in the context of its market cap, which at the time was about 120, 130 billion. So it invested about a third of its market cap into one company, Red Hat. Now what's happened? It's continuing to decline in share price while here the Dow Jones is growing. And while we'll see many other tech companies are growing, and what most people may not realize is that IBM today is only worth $110 billion. Google is 1.2 trillion, Microsoft 1.6 trillion. Salesforce, 200 billion. Salesforce is worth more than IBM today. Even Snowflake, the new cloud data company, cloud warehouse company, which just did an IPO in the last 3 or 4 months, Snowflake is worth 93 billion, almost as much as IBM. So there's some big messages that come out of all this that I really want to focus on now. And I think we can conclude a lot of blue chips are struggling. They're struggling. But what's really going on here? Let's look at the law of cause and effect. And what's really going on is we've entered a world of business as exponential. We go back 10 years to November 2010. 8 out of the 10 largest companies in the world by market cap were non-tech company. Only 2, Microsoft and Apple, were tech. They were valued at a total of $500 billion. 5 years later, it's grown a little bit. Non-tech is more or less flat. 5 years later, now today, tech has effectively declined in terms of only 3 out of the top 10 are non-tech companies from where they were in 2010. But look at tech. 7 of the 10 largest companies in the world are tech companies, and the total value is nearly $9 trillion. This is the power of exponential growth. And that's the reason why I'm putting Ray Kurzweil's quote here, because exponential growth is among the most powerful forces in the universe. Now, I want to combine this growth with something that I think many market participants take for granted, and that's the long-term interest rate. Some call it a bond bubble. The interest rate, the 10-year Treasury rate, has declined from about 15% in 1980 to near zero today. And this is one of the most important factors in all of the capital markets around the world, certainly in the US and certainly in tech. And what I want to point out here, and I keep this in mind as we're going through this presentation, ultra low interest rates could go negative, and I believe they will go negative, given the deflationary effect of exponential technology. And this is happening just when the governments need inflation more than ever because of the increasing debt loads that the governments and central banks are carrying. So what this means is the future free cash flows of these hyper growth tech companies are worth more today on a present value basis. It's one of the reasons why we see Tesla valued at $600 billion. This is the reason. It's the increased expectation that interest rates could go negative, and all that future cash flow that Tesla would contribute is just worth more today because of that. Now, that's one big reason, but there's another big reason, and that is all industries are tech now. They're going tech, and it's all advancing exponentially fast. I just did this about a half an hour ago. I just wanted to see simplistically, back of the envelope, what was it like 30 years ago? Where was the NASDAQ 30 years ago? 30 years ago, NASDAQ was at 373. We all remember this dot-com boom. It seemed absolutely insane, crazy at the time. It hit 5,000 in 2000, March 2000. And it took a long time to come back. But this is the power of exponential technology. Also, it helps to be combined with ultra-low interest rates. This has increased by 34 times in the last 30 years, from 373 to 12,633. Meanwhile, an index, a more normal index, a non-tech index like FTSE, has only grown by 3 times. And this is a massive, massive difference, 34x versus 3x. Now, if we look at this in a more sophisticated way, which we did for our Death of Value Investing research, we looked at total compounded total shareholder return, because many people will say, well, you're not taking into account the dividends and stock splits that we often see with more traditional companies. Well, here we did take into account all of those things. And again, tech blows away every other sector, blows away non-tech. It's not even close. Now, many will say tech comes with risk. It comes with volatility. And therefore, you can't just say it's the right place to be. Well, we looked at this as well. And if we start looking at this in a simple way, last year, 2019, tech performed the best of all the sectors that traded at over 50% return. In the first half of this year, during the pandemic, what we found, and this is extremely interesting to me, is that tech was up 15%, was up while all the other sectors were down. So where were the big losses from the high risk tech? So during our study, we looked at this a little more closely. And we wanted to see what was the maximum loss from the first day of trading in every year going back to 1995. And what we found was that since 0809, Every year except one, the red here, which is non-tech, every year except one, the non-tech sector had the bigger loss compared to the tech sector. Now, for tech, we're using the NASDAQ 100. For non-tech, we're using the indices, the FTSE 100 DAX and the CAC 40 as an approximation. But this certainly shows that tech is actually safer than non-tech. And the FT pointed this out in June this year when it said, has Buffett lost his touch? Is Warren Buffett too big, too slow, too old-fashioned? And I would say, if you check, as I did today, because I was curious what the constituents are of the Berkshire Hathaway effective index, Apple is by far the largest holding now of Berkshire Hathaway. It's $115 billion. It's 5 times the Apple holding by Berkshire Hathaway. It's 5 times the size of any of his other holdings, including Coca-Cola and Kraft Heinz and all the others. Now, it's not just the quoted companies. Let's look at venture capital. Remember the dot-com heady days here? This was huge, the amount of VC money going into tech companies in 2000. Well, even this is blown away today by the amount of money that's going into venture, that's going into tech in both North America and Europe. We're also seeing it in unicorns. A unicorn is a private company valued at over $1 billion. And I find this fascinating. Only about 10 or 11 years ago, we were seeing 5, 6 a year. Today, we're seeing over 100 a year. This year, we're going to see 100. We had over 100 last year, 120 the year before that. So the unicorns, which we now have over 504 of them in the world, are growing exponentially in number, and they're also growing exponentially in value. Here we see many of the familiar names that have already done an IPO this year. Now, these are the current private companies valued here. I also want to show the ones that have already exited. Since 2011, in 2011, only $12 billion worth of unicorns had exited. Today, it's $3 trillion. This is either through an IPO or a sale. By the way, this doesn't include Tesla, which was a unicorn because it was listed in 2010. So if we added Tesla to this list, we go back to 2010, this would be $3.5 trillion because Tesla's $600 billion now. So this is a phenomenal force that we are experiencing. And every investor and every decision maker and every large corporate, mid-sized company needs to take this very seriously. It even goes to the smaller levels. So we talk about these bigger corporates and unicorns. What about the small companies? Well, there are already over 500,000 tech companies in the world today. They're growing at least over 100 a day, 100 companies a day, being funded at over $1 billion a day. And it's all these advanced technologies that are now growing exponentially. And they're spreading into every industry. There's no industry that's untouched from new advanced technology. In fintech, which many of us are familiar with, there's 70,000 fintech companies. EdTech, 29,000. Fashion tech, 18,000 companies. Logistics tech, 13,000. Agritech, 5,000. It's everywhere, exploding. And it's just starting. 5G's coming, as we all know, maybe from the iPhone 12 launch. If you haven't seen that event, you got to watch it. The impact of 5G is going to start next year, and it's going to be huge. It is going to create new industries. We're going to see incredible improvements in network efficiency and throughput, connection density. We're going to have incredibly reliable machine-to-machine communication, which will allow for self-driving cars and self-driving taxis, air drones and air taxis, and healthcare will change dramatically because of 5G. Now, this is disruption. What does disruption look like when we see it in the company? Well, I want to point out this case study, Peloton versus Technogym, which is interesting because if you go back just a few years to 2017, Technogym had more revenue than Peloton. Let's go forward a year. All of a sudden, Peloton's bigger than Technogym. Fast forward another year, 2019, we're talking about 3x. Peloton is rocketing forward, and they have approximately the same gross margin. Peloton was losing money, and yet it's valued at nearly 10 times the amount, over 10 times the amount of Technogym with only twice the employees. And I want to point out that if you look at the trailing 12 months through September 2020, Peloton is now profitable, generating 112 million of EBIT. The body value, which is the valuation, enterprise value per employee for Peloton, is 7 times higher. The market is saying that a Peloton employee is worth 7 times more than a Technogym employee. What is going on here? Peloton gets it. Its DNA is technology. Its DNA is where the customer, where the consumer is going, how the consumer is changing, using mobile phones, using apps. So Peloton has acquired 6 companies here in the last couple of years. It is absolutely focused on where the world is going exponential. It's taking advantage of that. If you're an investor, I'm sorry to say, if you happen to be invested in Technogym, if you're an investor, there's no point to be in Technogym. There's no point. This is where the action is and will be until the end of time. It's not going back to the way it was. Now let's look at the blue chips who are embracing this disruption and who are going tech. And we're going to start with Walmart, which I think is still my favorite case study. Now you look at this chart and you think, oh, it's all Amazon. Amazon's amazing. Let's talk about Amazon. No, we're not going to talk about Amazon because everybody does talk about it all day long. Let's talk about Walmart because what Walmart has done is quite amazing. Let's zoom in on here. This time frame from January to November 2015 was a key moment because Amazon was moving from books into e-commerce, was growing incredibly rapidly, 124% during this less than a year time frame. Walmart declined by 34%. Now, this is the largest retailer in the U.S., a big blue chip. Declining by 34% is a big deal. It doesn't happen every day, at least not within a year. And Walmart isn't stupid. Walmart is an incredibly smart company run by a phenomenal chief executive, Doug McMillon, in my mind. And so what they did was they made the right decision. They decided on fixing the Walmart.com website, which just wasn't working very well, and after having spent hundreds of millions of dollars, they just said, let's acquire the very best company we can, e-commerce company. Jet.com, Mark LaHora, who founded and led Jet, let's pay 13 times revenue, even though it's only been set up less than 2 years ago and it's losing money. This company, its DNA, its people, its talents, ideas, its platform can solve our problems or help solve our problems. And it did. The team came in and they solved the Walmart.com problem almost immediately. Within 1 or 2 quarters, Walmart.com revenue was growing by 30-40% a quarter. And after 16 months, Walmart had generated $60 billion of market value here, and it kept going. It acquired Flipkart in India for $16 billion in 2018, which I have to say probably wouldn't have never happened without Jet.com because of the mentality change, the mindset, the confidence that if we can do this with Jet, we can do it with anything. We can do it with Flipkart, and we can do it with other digital companies which Walmart acquired. And Walmart has gone from strength to strength, while other retailers have fallen by the wayside. It's made 13 digital acquisitions, but even more importantly, since acquiring Jet, it's grown its organic innovation. It's exploded. These are patent filings. Walmart's filing hundreds of patents every year in augmented reality, virtual reality shopping, blockchain-enabled trucking fleets, wearable tracking devices, face recognition. Walmart has become a technology company. This is the largest retailer in the U.S. with 1.5 million employees. And I say to all the blue chips, if Walmart can do it, all of you can. There is absolutely no reason why you cannot do it. Because Walmart has done it. And I just want to finish up by looking at Walmart versus Kroger. Walmart's looking like a tech company. Again, Kroger has about 435,000 employees. Walmart, 1.5 million. Walmart is delivering value. Its employees are worth more, even though it's a larger company, and it's delivering the share price returns to shareholders. And finally, this is the slide that does it for me. Going tech has been like magic for Walmart. So these are the number of acquisitions or investments in tech companies that any of these grocery retailers have made. And by the way, grocery accounts for about 56, 57% of Walmart's revenue. So it's a very significant part. You could say that Walmart effectively is a grocer. So it's acquired 18 or invested in 18 tech companies, and it has had the highest share price performance after 3 years here at nearly 100%. It's 67 times larger than Casey's, which is the next best in terms of share price performance. How is that possible? Elephants aren't supposed to dance, right? We learned this in business school. Elephants are supposed to be slow, like Technogym. They're not supposed to do this. They're just not supposed to do it. But Walmart has done it because of this. It has become a tech company. It's delivering the shareholder price performance. But wait, there's more. PetSmart. Most people aren't familiar with what PetSmart has done with Chewy. And credit to BC Partners for one of the best private equity deals of all time. My buddy Ray Svider knows what he is doing here. And I say that when much of the media and press have poo-pooed the Chewy deal because they lost the founder, there have been some problems. Well, let me show you what's happened here. Now, don't freak out at the detail in this slide. If you guys have been to business school, just bear with me for a minute. I'm going to point out what's going on here. This chart shows BC Partners ROI in the PetSmart Chewy deal. So in 2014, just bear with me, it's worth it. BC Partners acquired PetSmart for $8.7 billion, using only $2.5 billion of equity. Then only a few years later, they decided, like Walmart, we've got to do the right thing. We've got to make the right decision. We have to go to where our consumers, our customers are going. We have to acquire the best online e-commerce pet company in the US, which was Chewy. They paid 3.35 billion. So a huge chunk compared to the 8.7 that they paid for PetSmart itself. And they only used 1.3 of equity. So they really took a bet here. It was 4 times revenue. They took a bet because they used a lot of debt. So now BC Partners' total equity investment was up to 3.9 billion. What they've done is built Chewy and invest in it, and they ultimately spun it out in an IPO. And just to cut to the chase here, they've taken some money off the table. This 6 billion is what we're assuming BC Partners has done with the core PetSmart business in terms of increasing the equity value here. But all of this is Chewy. And in fact, while Chewy's market cap today is actually not 31 billion, I checked it before the call, it's now 38 billion. So in the last 2 weeks, it's gone from 31 to 38 billion. BC Partners' total equity return on this whole deal is $30 billion. $30 billion, right? That's in 6 years, a 600% ROI, 7 times multiple. And on Chewy, it's 14 and a half times. And what I love about this case study, we see it all the time, is the commentary. Forbes said in May, at the time of the Chewy acquisition, I would have thought it was a great acquisition at less than $1 billion. But at 3.35 billion, Chewy may not be worth the price. Okay? This was 3 years ago. It should have been worth $1 billion. Well, it's worth 38 billion today. And I'd like to point out that people said the same thing when Facebook acquired Instagram for less than $1 billion. Instagram's worth over 100 billion today. They say the same thing when eBay acquired PayPal in 2002 for $1.5 billion. PayPal's worth $280 billion today. They said the same thing about Google acquiring YouTube, and the story goes on and on and on. This is true value creation. Now you ask, are tech acquisitions just in retail? No. GM Cruise, a little bit like PetSmart, Chewy, but I'd say even better because GM has gone all in terms of integrating Cruise to the point where Cruise is the future of the company. Now, many people poo-pooed GM at the time. It acquired Cruise in 2016 into 600 million valuation because it was generating zero revenue and it had something like 100 employees. And they knew what they were doing. GM, like Klaus Schwab had said, looked at the forces of disruption and innovation in its next 5-10 years and decided in 10 years' time, all vehicles will be electric and self-driving. And we need to be the best. We can't do it all in-house. We have to acquire the best. We're going to acquire Cruise, and they did it. And not only did they do that, they very intelligently raised capital from external sources while they diluted down from 100%. So 2.3 billion from SoftBank and 11.5 billion valuation. That's 2 years later. Dan Amon, who was the number 2 at GM, said, okay, it's time for me to run Cruise. And the Cruise founders were great. Super. Dan, thank you for joining, because now we know that if you're running our business, there's a better chance that our technology that we created, that we founded, will be on millions and millions of vehicles. We're happy to let you have the reins. We'll step back because you're going to help make our dream come true. And that's what they've been able to do. They raised, this is an especially interesting investment, 2.8 billion from Honda at a 15 billion valuation, but 2 billion of that was an R&D investment over 10 years that basically Honda licensing technology from GM, from its competitor, which is the whole point of what we call a techquisition. And then a year later, 9 months later, they raised another 1.2 billion, T. Rowe Price coming in. And here's what I find interesting. Even I was surprised when I read this in the Financial Times, September 2018. So around this time frame, analysts at Bernstein estimate that GM's public projections for Cruise could ultimately imply an equity value of more than $700 billion, 14 times GM's own valuation. Now, I read that and I thought, yeah, that's probably a little bit too much. However, knowing now that Tesla, yes, we know some of the reasons why it's worth 600 billion, but Tesla worth 600 billion today, this number starts to look a little more realistic. Now, 700 billion compared to 600 million is about 1,000 times ROI. This is serious stuff, right? This is real. These aren't made up. This is not a bubble. Let's look at McDonald's. McDonald's has been performing for a long time. We map it here against the Dow Jones. McDonald's has been investing in acquiring technology companies. In March of last year, it paid $300 million at a 17 times revenue multiple for Dynamic Yield, which is mobile personalization software that McDonald's believes can allow it to help its customers at drive-thrus adjust for the weather, help them choose their menu, make everything easier. But it isn't just that. It's the people. It's similar to Walmart with Jet.com. And in fact, the global CIO of McDonald's, Daniel Henry, said this dynamic yield acquisition is probably less about the product and more about the data scientists and the people that come with it, the people that will help us move quickly. And this is something that many companies miss, is that new talent, that fresh talent coming in, bring new ideas. They help that innovation go from optimization to transformation. And that's what we're seeing with McDonald's. We have another one here. This is Prudential Financial, September 2019, paid 2.35 billion upfront plus another 1.15 billion earnout for IQ Assurance. IQ Assurance only had about, or Assurance IQ, I should say, only had about 120 employees. They're paying something like $19, $20 million per employee. And what's also interesting about Assurance IQ is that there were two founders who bootstrapped the company 4 years earlier. So in 4 years, two founders bootstrapped a company, no VC money, sold it for, well, over $3 billion to Prudential Financial, and they had accumulated 17 million customers. And what Assurance IQ does is they use AI to match buyers with customized solutions for life, health, Medicare, and auto insurance. And the platform gives options for the customer to purchase online or could go to an agent, and it even matches the best agent or the best online process to fit with the particular needs of the individual. And it helped Assurance IQ build 17 million customers before selling out to Prudential. Now, also, Prudential did this deal when its share price had dropped the month earlier by 20% because of some bad earnings. And yet, when they announced this deal, share price goes up 13%, 4.2 in value, basically pays for the deal. Let me go to another one. Lululemon acquiring Mirror. This happened this year in June. I think this is a brilliant deal. So basically, they're paying only 5 times revenue versus what we see today with Peloton at 13 times for an overlapping customer base between Lululemon and Mirror. And Mirror, by the way, is a mirror you can put on your wall or on a stand. You see yourself with a trainer or a group, and you have personalized sessions and music and training sessions. You can do one-on-one. You can do all kinds of things similar to Peloton, and it's interactive and it's fun. It as I understand, growing like hotcakes. That's what it does. So they have these two companies, an overlapping customer base. Mirror could help reduce the group customer acquisition costs, partly because of that. They can lower the cost of content creation. They can increase the margins of Mirror as it grows. Also, this is a diversification play, which is very important for shareholder value creation over time, and increase Lululemon's presence in this global physical activity market. So Lululemon is yoga clothing and so on. But this helps Lululemon enter a massive new market, and it's really part of the $3 trillion market for global wellness. This is a phenomenal techquisition that Lululemon has done this year. Now, Compass Group, which has, I think, about 600,000 employees based in the UK, which runs many companies, canteens, cafeterias, etc., was really struggling, as you can gather, during the pandemic. So in May, in the middle of the pandemic, in the middle of having to make huge redundancies and shutting down divisions, they acquired a little meal kit food delivery company that was designed for company canteens called Feeder for $24 million. Feeder immediately adapted its model to employees of companies who are living at home. And the increase in market cap more than paid for this deal. In fact, the overnight rise was 100 ROI on the deal cost. And the price continued to rise. It's just the market recognizing the value. Of course, these things play out over the long term, and they should do, as we've seen with Walmart and Jet, for example. But the market is immediately rewarding these types of deals because the market tends to be smart. The market tends to know what I'm talking about here today, that everything is going tech. And when they see Compass Group making an acquisition like this, they applaud it. They applaud it. This is what companies should be doing. Let's do another one. Nestle, which very recently, and just about a month ago, announced the acquisition of Freshly, a US-based meal kit company. Now, the meal kit sector has been through all types of troubles over the past 5-10 years, and there hasn't been a lot of money made in meal kits. Freshly still probably losing money, however, growing rapidly. Nestle said, it's time to be changing our model. They also acquired Mindful Chef in the UK, smaller company, a few weeks later. Now, in this deal, we see there's probably an immediate 20 times ROI, with Nestle's market cap rising from 313 billion to 343 billion. And we looked at any other factor that could have lifted the SMI, and we think it basically lifted the SMI, this deal. Again, the market applauds established blue chips who are seeing the future, that it's going exponential, it's going very, very fast, it's going to last after the pandemic, and taking action. And if we also see a bit of a longer term picture with Nestle, when Third Point came in 2017 and said, look, Nestle, you have to sell assets, yes, but you also have to achieve bolt on acquisitions in high growth advantage categories. That's when Nestle started taking action. They've made 8 acquisitions since then, and it's certainly outperforming its peers, Unilever and Danone. Now, just one more. Who's been doing this for a long time? Because some of you might be saying, oh, well, Paul, you're showing share price increases after a few days or a week or two, maybe after 2 or 3 years. Who's been doing this for a long time? And it's a company not many people talk about, Home Depot. Phenomenal company, growing revenue, growing gross margins, growing operating margins year after year, consistently, solidly. If you've taken finance, you know that this is what we all want to see, a straight line up. Obviously, it would help if it's exponential, but Home Depot will be, in my view, over time, developing a more exponential looking a share price line. It's doing everything right. And it's really 3 things that companies should do. They should have a tech-focused strategy. 2018, Home Depot announced that it's melding its supply chain, digital footprint, and physical store experience, having spent $11 billion on that to date to get that right. They even launched before a university-based innovation center. They've been making tech acquisitions, tech investments, and they've been doing many different partnerships with technology companies to ultimately do what Amazon talks about, is delight the customer. Jeff Bezos will always talk about the customer first. If you listen to him, Home Depot gets that. If you study this case, you'll see that Home Depot is very focused on the customer. By the way, same thing with Walmart. Doug McMillon at Walmart will talk about the customer because he said that's what Sam Walton did. Even though they didn't have any technology in 1950, Sam Walton was always focused on the customer. And I would end here. I'll have a few more slides, but I'm going to end and say that all of this boils down to the customer, who is a human being, and it's the human being that is being influenced by the exponential technology in their lives. And that is the dot connecting that we have to do when we are either operating companies or investing in them, is what are these companies doing? What can we do when we're making decisions about our resources to go to where the customer is going, or where the customer will be taken by different technologies? And so the lesson in all of this is that you got to go tech or you're going nowhere. And just to point out our view, and yes, I'm going to make a prediction here. I'll step out and say that while this is the chart we saw earlier, the TSR of the different industries up to today, 2020, if we go out another 20 years, which if any of you have kids and you want to save in their pension, there's no point to put capital, long-term patient capital that's going to compound pre-tax year after year. There's no point putting it anywhere except in tech. Now, yes, we're going to have a crash. I can't tell you exactly when. We're going to have another crash. We're going to have another crash. But it doesn't matter anymore. When I saw the crash in 2000, 2001, 2002, 2003, long neutral winter, I thought that maybe was it. There was no more tech. The tech thing was done. Now I can say with utter certainty, it's not done. It's just getting started. It's going to explode. So we could talk about this maybe in the Q&A. What does it mean for you, depending on what your role is? If you're a CEO, a corporate executive, we've been talking about it here today. You've got to invest in and acquire technology companies that are the right fit. If you own a non-tech company, you need to start going tech, both organically as well as consider partnerships. If you're an institutional investor, you really need to think hard about the companies you're investing in that are not either tech companies or they're not technology enabled. If you're a family office and you have a bias to investing in the same industries that perhaps the family became wealthy from exiting over a period of time, well, it's time to think maybe a little bit differently. And maybe it's time to start thinking about only investing in technology companies or tech-enabled companies. If you're a board director, if you're not an exec board director of a corporate, it's your responsibility to be reminding the executives of what's going on out there in the world over the next 3, 4, 5, 10 years. And the new way of thinking. If you're a private equity executive and you're running a portfolio of non-tech traditional established companies, it's time to take action. You've got to take action now on helping those companies techify themselves. If you're a venture capital executive, you're in the right place, you're doing hopefully the right things, but it's going to get more competitive. There are more tech companies growing all the time. They're getting better and better and faster, and so are the VCs. A lot of VCs are already going algo. So it ain't easy And I wouldn't suggest that you should expect that a rising tide will lift all boats. It's going to get very competitive. If you're an entrepreneur, tech company executive, you're probably doing the right thing. Just keep going, keep course correcting and pivoting, and stick with it. And if you get it right, you will go far. And if you're a student, keep learning, keep reading. And I guess it was the 60s or 70s when that movie The Graduate came out, and we heard the whisper plastics. Well, the whisper today is tech, because that is where the world is going. All right, so that's basically it. Happy to take Q&A if we have time.
Well done. I mean, that was a real MBA grad keynote. A lot of data, a lot of numbers. So let me ask the first question, which is a bit, I like everything I heard, but I believe that we are in a bubble. Snowflake trades at 245 times revenues, 245x, not more earnings, revenues. Well, I know that Snowflake from in 2050 will be probably worth more than now, but I cannot buy 245x revenues. What should I do?
Well, start out with, why is Tesla worth more than GM, Ford, Honda, Toyota, basically the entire industry? Why is Peloton worth more than Technogym and probably other competitors put together? It's the same with Snowflake. It's the same with Cruise not being worth 600 million. Today it's worth 20, 30 billion. It's going to be worth 700. The same with the other examples I gave. We humans think in a linear format. We just naturally, we come out of the cave with a spear and we're trying to catch that bear, right? We're not thinking exponentially. Technology builds on itself. It's growing exponentially. To answer your question, I'd say read Ray Kurzweil's The Singularity is Near, because what's happening is values being created by continued automation, digitization, fewer and fewer humans, decisions being made more accurately with better quality data, with more data, faster, and that value is delivered to the customer. It's what frankly got Snowflake to where it is today. And I'd say Snowflake is just beginning, and it will ultimately earn its way into its valuation. Although having said that, today it's probably priced for perfection. Personally, I'm not a buyer at Tesla at these prices. I'm not a buyer of Snowflake. No. What I would say to investors is, as we did say in our Death of Value Investing report, is invest a little bit, same amount, every month, and every month. That way, you're going to be paying top price at some point, but you're also going to be paying the bottom price at the bottom, because no one can truly know. And I would just add to that to say, again, one of the reasons for these high prices that are priced for perfection is a view that I think the markets have over the long term, that interest rates could go negative, and that the force of exponential technology is fundamentally deflationary. And that means that, again, the future cash flows generated by Snowflake are worth whatever they would be worth 5 years from now, essentially the same today. That's a very big question. And I think that's something that every investor has to think about and has to study. But I certainly wouldn't be advising anyone to take all of their capital today, invest all of it at current price levels.
Okay, very good. Then we have a question from Emmanuel, who will enrich, which is very relevant to me as well. He asks, could you say there are certain sectors for which this advice does not apply? And my enrichment would be, there are clearly some industries which are more digital, like fintech, financial services, and others which are less digital, manufacturing, for example. So how would you say technology becoming ubiquitous from an industry perspective?
Well, it is. I presented a chart there that shows that there are tech companies being formed in every single industry, in every niche. And it's just a matter of time before that catches up with an established player. Now, to qualify that question, I think it would help to describe the size of the company within the industry we're talking about, because a $200 million revenue company has plenty of growth, even if it's not fully adapting to the latest technology processes because it can capture market share, because it can do certain things as a small company that the larger corporates can't necessarily do. It can move faster, for example. It can acquire or hire talent that may be offered options that could have a greater upside, for example, that a much larger corporate can have. So it depends on the size of the company, but the answer is every single industry is going to be transformed. It already is being transformed. I mean, food is a good example because food, you think, well, that's pretty standard. You have a farm and you rear cattle or perhaps vegetables, and you farm the land or you breed cattle and you produce meat and you produce vegetables and fruit. Well, all of that is changing, as many of us know, not just plant-based, but lab-based. So it won't be long before we're not killing cattle or sheep or pigs or chicken or fish anymore. It will come from the lab or it'll be plant-based. That's like going from the horse and cart to the automobile. Every single industry will be impacted. So name one and we can talk about it, but I'm quite clear about that.
Okay, good. Here's a question from Brian, which I will read. And you mentioned a lot of positive acquisition. Nestle may have made the acquisition outperformed the peers, but did Unilever and Danone definitely not try M&A too? So they might have tried, they might have done, but gone bad. And my enrichment here is put yourself in the shoes of a C-level that has to pull the trigger and buy tech companies which are either too small or too expensive, and things can go bad, things can go wrong. So what would you say to that C-level?
So what I haven't talked about here is the how. That's absolutely correct, by the way. Things can go bad because nothing in life is risk-free. That's a whole other discussion. So things can go bad. There's always some risk. The question is, how do you reduce that risk and increase the probability of a phenomenal return? And the return is not just direct, but indirect, as I was talking before about the new people, fresh thinking, the DNA effect. And so the how is something we as a firm and I spent a lot of time on. That we actually have a trademark methodology we call Techquisition. It's got 12 steps. And if a company goes through those 12 steps very carefully, then there's a high probability it's going to be a great deal and it won't go wrong, even if people in the company leave and executives in decision-making positions change their position, change to different divisions or leave the company. It's not entirely fail-safe because nothing is, but there is a how. I can't speak to the detail of what Nestle and Danone and Unilever have done. I know some deals they have done. I can see the performance, and for sure, the performance of those three is not entirely down to Techquisition or acquisitions they've made. It's down to a lot of other things, but they are signs. And yes, correlation is not causation. However, there are signs there, and I think just by asking the question, it's a great start.
Very good. Ken asks macro questions. So he says, once COVID is fully controlled, 2-3 years, inflation comes back, rates start to rise. How would this affect startup funding negatively and technology companies? And the inflation story was a very interesting article in Economist last week, and everyone thinks inflation is dead. I don't, but what do you think?
Of course, nobody has a crystal ball. And I've changed my view on this over the last 2 or 3 years. And even during the book, when I wrote the book, my view was interest rates, this is highly unusual, unprecedented, negative in many countries. It's got to change. At some point, the low interest rates will produce greater economic activity. It'll lead to inflation. And that's going to cause a lot of problems for certainly companies with leveraged balance sheets, et cetera. But we haven't seen that. Yes, the stimulus from the pandemic has something to do with it. But I've changed my view. I think that technology is now moving so fast and taking over our lives and taking over industries and creating efficiencies in a way that will actually will continue to be more deflationary. And let's just say, so I don't think interest rates will rise for some time because of that, which is a view that I've changed. Now let's assume that rates do rise, and that we do have inflation. It doesn't change anything. When it comes to decisions, let's separate maybe investing in tech stocks from decisions that executives are making in companies. Decisions that are made by executives in companies shouldn't change much at all, whether interest rates go up or not. Technology continues to grow in the form of products and services and ultimately value delivered to the customer. If we're talking about investors and where should they invest and where should they put their money, well, first of all, if what happens or when what happens, what we just described, where interest rates move up, we're going to have probably a pretty big market crash. And I've lived through about 3 of them or 4. So I know what they look like. I know what they feel like. I lived through the 2000 crash. I'm not scared of a crash anymore. I've been actually kind of expecting one for many years. Hasn't happened. It doesn't look like we're going to get one for a while now, which again, I changed my view on. But let's assume we do get it. What do you do? And it's one of the reasons why our general advice is to, if you're investing, and I know it may be difficult for an institutional investor where you've got parameters and quarterly requirements, but it's to invest a certain amount every month over the long term. Playing the game of quarterly investing is almost like being a trader. And this whole talk, as you can tell, has not been about trading. I'm not talking about trading in and out on a quarterly or a monthly or a weekly or an hourly basis. That's a different thing. This is about true investment. So look, Warren Buffett, price is what you pay, value is what you get. What we're talking about here is true value. True value, regardless of interest rates. If interest rates go lower, you take advantage of it. If they go higher, then you take advantage of probably lower asset prices that will result. And that shapes your investment approach.
We have a question from Andrea about the antitrust. So he says a lot of value created by tech is free for consumers. So antitrust does not apply. However, tech companies are big and growing exponentially. Do you expect regulators to react, and how?
So yes, I do, because they will continue to grow, and I don't think it matters really. That's again something that the general business community, it's the press, they love it, the media loves to talk about it, it's exciting, it's interesting. I don't think it matters. So Facebook has to spin off Instagram, has to spin off WhatsApp. Those companies on their own will just grow even stronger. They'll figure it out. They'll find a way. I love the story of PayPal, right? Because the story is eBay bought PayPal for $1.5 billion in 2002. Everybody screamed, "Oh my God, that's unbelievable! $1.5 billion for tiny little PayPal." Then they grow it and they spin it out. I think it was 2015 for $45 billion. I think it was bigger than the value of eBay on its own. Now, what happened since 2015? PayPal on its own continues to grow and strengthen and is worth $280 billion today. This is the thing about tech companies is they follow the exponential trend of where they're supposed to go. It doesn't mean they don't have competition. It doesn't mean it goes on forever. Of course, they have to continue working for it. But I think if we have breakups and bust-ups, we'll just have more companies amounting to the same total market value, and they'll either continue to grow or they will be taken out by the next big tech company, which I'd say it's inevitable. And so we haven't talked much about what's the next. TikTok has only been around a couple of years, and now we're talking about Roblox. How long? It takes 6 months, a year before the next massive multi-decacorn company emerges. We haven't talked about augmented reality, which is going to be a new form of social media with AR, what's possible there. We haven't talked about immersion technologies and VR, which is coming with 5G. It's a year or two away. It's going to blow people away. Again, most people haven't experienced this, but in terms of the applications for business, for entertainment, for education, for health, they're phenomenal. So this talk about breaking up companies, it's just the nature of the beast. If you're an investor, it doesn't really affect anything. If you're a competitor, it doesn't affect much, except maybe it gives you a perceived chance to go after them. If you're a non-tech traditional company, ignore it. It's noise. And that's, by the way, one of the big lessons here. The companies who have done this well, they have been laser focused on their mission. The companies we work with on the 12 steps of techquisition, we stay laser focused on that. We get it done right because it pays in spades over time. Don't get distracted by all the noise.
Let me ask the last question since we have no one else from the audience. Well, we have one. My question is about corporate venture capital. Mm-hmm. So you are not positive about CVC. I am positive, very positive from CVC. Why do you think that CVC doesn't really work for corporate?
I'm not sure that thanks, Ellis. I'm not sure it's a positive or not positive on it. It's a question of degree. It's not black or white, it's gray. So if a company is using CVC as a crutch, that's wrong, right? Oh, we have, technology, we do that. There's a few people in this division called venture something. That's not good. That's not going to help. That's a distraction. If it is part of an overarching mission to transform the company over time, to bend towards where your customers are going, then CVC is a good thing. Look at Home Depot. Home Depot has been, and look at Walmart, which has a venture fund. There's a lot of things that a CVC fund can do. So I think that's the important qualification, that as long as the company is also focused on acquiring the companies that really matter to the core business, that move the needle, that help that company deliver better services, better experience to the customer. The second thing I'd say is, if a company is going to do CVC, then, and this is a change that I had, because you're right, a couple of years ago, I didn't even want to talk at all about CVC because I didn't think it mattered that much. We've had a few clients ask us, okay, propose to us anyway, even though we know you don't like it much. Propose to us anyway. How would you set up a venture fund? How would you do it? What should we do? How would we do it? So we went away and thought very hard about that. How would we do it? And what we concluded was that a CVC fund could, in fact, be very powerful if it embraced the techquisition methodology, which is essentially truly understanding the reason, the purpose, the mission of that CVC fund as it relates to the parent company. What is it actually trying to do beyond experimenting and learning and getting exposure for our employees to tech and maybe earning a financial return? What can it really do for us? And then once that's clear and we know where in the value chain that we should be looking, we should be refreshing our screening of the tens of thousands of companies around the world every quarter. Every quarter we should be refreshing, doing the deep dive. We should not wait for people to come to us. We should be going to them. We should find the targets that are the perfect targets for our company. And maybe it's a bit too early for us to acquire that company. We should go find them. We should approach them. We should explain why we're so excited about what they're doing. Okay, we know they just did a round. We're interested anyway. Okay, we love what you're doing. We want to invest. We want to be part of what you're doing. And 8 times out of 10, the CEO, the founder, the management team will say, hallelujah, thank God. Someone who actually is genuine, real, loves what we're doing, wants to be in, wants to help us, wants to grow, wants to create 1 + 1 = 10, wants to make it all work and wants to win. Now, if a company takes that approach and they execute it well with the right team, then a CVC fund can be incredibly valuable and powerful. It's not easy to do. I mean, most things that deliver value are not easy. No pain, no gain. But if you do it well, you do it right, you do it with passion and energy, and if the executive committee, the senior management of the corporate, gives it equal importance to another operational division, then it can be very powerful.
Well, we have the very last question from Andrea about Salesforce case. So Salesforce has recently purchased Slack. The question is, do you think the Salesforce is on the right path, or is becoming like Oracle, which means an old-fashioned B2B that acquires newer tech just to stay alive, but it's old?
First of all, I don't think Oracle is doing anything to stay alive. Oracle is actually performing very well. And Oracle's market cap, by the way, I think is 170 billion now, much larger than IBM. And I'd say Oracle is doing better than IBM, so be careful there. Salesforce is a wonder. And I think Mark Bainoff, don't bet against him. Okay, similar to Jeff Bezos. Leaders can make a difference. And I don't want to start going down that discussion to go off track from Salesforce, but Salesforce has surprised me. I followed it from the very first days that they were founded, and I have been surprised how they've gone from strength to strength. They have acquired many, many, many companies and have done very well acquiring those companies. And a company like Salesforce, when it looks at Slack, don't bet against it, is what I would say. It knows what it's doing. If there's any group of people, of decision makers, of judges in the world that are able to assess whether Slack is the right acquisition, it's Salesforce. They know what they're doing. It's highly unlikely they would screw that up and make a mistake. Partly because Mark, the founder, is there. He's on top of it in the same way that Jeff Bezos is generally on top of all of their acquisitions. Look at LinkedIn and Microsoft. Nadella, they paid, I forget now, 21 billion, 22 billion for LinkedIn. That was a high price at the time. But look at LinkedIn. LinkedIn is going from strength to strength. They're integrating that into Microsoft over time. It's just going to get better and better. Some of us hate it, but it's there. But when it gets really good in 2 or 3 or 4 years, when AI and big data is really good, and we've got AR and we've got holograms, and we'll be doing these kind of meetings in 2 or 3 years with 3D and holograms, yeah, you may be laughing, but it's going to happen. Then, we'll say whatever Salesforce ends up paying for Slack is nothing. And it sounds almost crazy for me to say that. But then you could say the same thing about almost all the big important deals that have been done in the last 10, 20 years.
So now I will just want to thank Paul for his time, to everyone for attending. We have 49 people left, which is good. So we'll end the session and you can get to the table, talk with your table mates, and maybe you can join Paul on other table, or even me if you want to speak with me. So thank you much for everyone, and have a wonderful holiday season to everyone.
Thanks, Alessandro.